remind me to reintroduce myself. My name is
My name is Sebastian Safela. So if you've been watching my videos, then you should have a good idea of what real estate is and why I think it's a good investment. I mean, don't get me wrong, I don't think it's good for every situation, but there's so many benefits to it that I think that at least everyone should consider it or trying to learn more to see if that's an investment you want to add to your portfolio. So whether you're investing long-term or short-term, you do so to increase the value of your money today and hopefully get a nice return later. But how do you calculate the return on investment, or ROI, in real estate? And how do you know what's a good return? The return on investment is a crucial number to know as an investor. So it tells you how much interest or how much money you're making on your money. So not only do you want to know how much money you're making on an annual basis, you also want to know what that amount represents compared to your initial investment. For example, say you put $5,000 in a bank account and on the same day of the following year, your account balance is $5,100. So you know you made $100, but what does that amount represent? How much interest did you make on your money? A simple formula for return on investment for this example is ending balance minus starting balance divided by starting balance. So our ending balance is $5,100 minus our starting balance, which was $5,000, divided by $5,000, which gives you 0.02 or 2%. So over the course of a year, you've made 2% of your money. So is that good or is that bad? Well, I'll come back to that a little bit later. Now in real estate, the calculation is a little bit more complicated, but the concept is still the same. So when looking at the ROI equation, the numerator represents the profit you've made, so in this case $100, and the denominator represents how much money you've invested, so $5,000. So the return on investment equation is basically profits over investments. Okay, so let me give you an example. So I'm gonna use my phone just so I don't forget the numbers. So say that you bought a property cash for $200,000 and then you pay another $2,000 on closing costs and fees and another $18,000 just to make some renovations. So far you've invested a total amount of $220,000. Now, we know that investment properties, they have monthly expenses to keep the property running. So property tax, insurance, utilities, etc. Say you add all these up and it comes out to be $350 a month or $4,200 a year. Now the total income that you get from rent is $1,850 a month or $22,200 a year. Now to get the return on investment, you need to know the total amount of money that you've invested and the total profits or how much money you've made at the end of the year. Now for your total investment, we already calculated that it was $220,000. Now for the profits, that's basically income minus expenses, and your income were $22,200 and then the expenses $4,200, and that gives you $18,000. So that's your total profit for the year. So to get your ROI, it's $18,000 divided by $220,000, which gives you 8.18%. The return on investment that we just calculated is called cash on cash return because it's looking at what kind of return that you're getting in cash versus how much cash you've invested. Now let's pick the same scenario, but instead of paying cash for the property, say you put an initial 20% down and borrow the rest from a bank at 4% interest. So now that you have a mortgage, your closing costs and monthly expenses are gonna be higher. So now you spend $4,000 on closing costs and fees and the same $18,000 on renovations for a total of $22,000. Now, the property tax, insurance, and utilities stay the same because it's the same property, so it's the same $4,200. Now, in the expense column, you now have a mortgage to account for. So you could go on Google and search for mortgage calculator and then pick one that you like. And you could just plug in the numbers for the loan amount, in this case $160,000, and the interest, which is 4%. And then you could just put 0 for everything else. And that'll give you how much money you're gonna pay for your mortgage every month. So in this case, it's gonna be $764 or $91.68 a year. Now, your new total expenses per year are the one that you had before, so that $4,200, and then plus that $9,168, which gives you a total of $13,368. Again, because it's the same property, we're still getting the same income, which is $22,200 a year. And then to get our ROI, or cash on cash return, just like before, we need to figure out what's the total amount that we invested and what's the profits that we make at the end of the year. So for invested, we got $40,000, which was a down payment, plus $22,000, which was a closing cost, fees, and renovation, for a total of $62,000. And then for profit, which is income minus expenses, we get $22,200 for rent, minus $13,368 that was expenses plus the mortgage. That gives us $8,832. So our ROI is 14.24%. So you might have noticed that we got a higher return than before. I mean, it's still the same property with the same income, but more expenses. Well, that's because you use leverage or borrowed money. By not using all your money and using somebody else's money, in this case the bank, you're able to invest less, but you're making the same amount of profits. So if you're looking at the ROI equation, the smaller your initial investment, the higher your returns will be. But does that mean that you should try to borrow as much money as you can? I mean, no, because the more money you borrow, the higher your mortgage payment is gonna be and the more risk you're taking. So not being able to afford your debt, especially if you're planning on buying multiple properties, is not a situation you want to be in. And then plus, it's gonna take you a long time to build sizable equity and net worth. So some people like myself also look at the total return on investment, which also includes the equity that you gain every time your tenants pay their rent. So whenever they pay rent, a portion of that goes towards paying the mortgage, and a portion of that goes towards the principal on the loan, which builds your equity every month. So it's not cash that you could take and use, but it's crucial to understand and use that in your calculation because it builds your equity and builds your net worth. So in the same mortgage calculator you used before to get the mortgage payment, you click on the amortization schedule to see how much money went towards the principal for a year and use that in your total income calculations. So for the first year, $2,818 goes towards the principal. So if we factor that equity that we gained with the profits that we made before on the property, it changes our ROI calculation to a total return on investment. So that would be the $88.32 that we got before, plus the $2,818, divide the whole thing by $62,000, which gives us now 18.8% return. So what's considered a good return? Well, that's really hard to answer because it always depends on what you're trying to do as an investor. So somebody flipping properties is going to expect higher return than somebody buying and holding. So one of them is putting a lot of work up front and is expecting to make as much money as possible when they sell. And then the other one is buying for the long term and he's expecting less returns but more consistent ones over a long period of time. And then somebody buying $1 million properties is okay losing money every month because they understand that if they buy right, they're gonna make all that money back and then some when they sell. But with that said, a lot of people look at the US economy and use it as a benchmark. So the S&P 500 is a good representation of the US economy. So investors might say in the last 50 years, the S&P 500 has returned about 8 to 10% to investors. So if I'm going to invest in anything else, I want to make at least the same or more in terms of cash on cash return. Because if I'm going to make anything less, I'll just invest in the S&P. Investing in the stock market could be passive, meaning that you could make money without having to do any work. Investing in real estate could be more active, so you might say that if I'm going to be putting work and time to renovate and deal with tenants, I want to make at least a little bit more than what I would get in the stock market. So I want to make at least 10 to 12% cash on cash. And that would be a criteria that you make based on you, what you're trying to do, your financial situation, the market that you're in, and so on. And when you include the equity that you gain from your tenants paying your mortgage, your return increases even more to maybe like 15%. And then when you look at the amortization schedule, you can see that the total amount going to interest decreases every year, and the total amount going to equity or principal, that increases every year. So that just means that your total return just increases every year. And I didn't even talk about the forced appreciation that you get from renovating the property, which you can't do in the stock market. I mean, I'll leave that for next video, so if you want to see that, make sure you subscribe and hit the bell so you can get notified when that video goes live. So So that's all I got for today. If you think this video was helpful and you want to support this channel, make sure you tap the like button and subscribe if you haven't already. And don't forget to share this video with a family or friend you think might be interested in that type of content. Thank you guys so much for watching, and I'll see you next time. Peace.